Hi, welcome to this LNG market update. Today, we will review the highlights of our latest quarterly report. We will cover spot charter rates, LNG flows, new building activity, and asset values. As you can see on the left graph, spot charter rates were up 30% compared to the second quarter, but remained 30% lower than the same period last year. This can be explained by looking at both the shipping market balance and the development of gas prices. Talking about fleet balance, compared to the same period last year, the LNG fleet grew 5%, while we saw the first annual drop in ton miles for a quarter in years. Effectively, this means that the fleet utilization went down. And this was also the case when compared against the second quarter of this year. Although ton miles showed some recovery, this was not enough to keep up with new building deliveries. So this does not explain the recovery in charter rates. But for that, we have gas price development. On the right graph, we see this has been more consistent with spot charter rates, showing an year-on-year drop and a recovery from the record low prices in the second quarter. Despite COVID-19, the LNG market is expected to grow in 2020. The left graph is showing discharge of LNG versus 2019. What began as strong supply-driven market eventually turned into negative growth once the low gas price incentivized cargo cancellations. This has eaten up large part of the gains from the first quarter. However, as we approach winter and the call for more cargoes return, we expect some volume growth recovery in the last quarter of the year. In the center, we see that despite cargo cancellations, the US is still the main source of additional LNG in the market, and we expect this to continue in the next years. From the import side, Europe continues to be the main region for import growth, even if European imports slow down in the third quarter. Asia shows some soft growth year to date, but the region is hiding big swings. Chinese LNG demand continues to grow strongly, but Japanese lower imports basically cancels this out. Mexican LNG imports are behind the strong fall in Latin American imports. The specific development of trade flows meant that despite the sharp slowdown of volumes in the second and third quarter, longer sail distance has prevented a full negative impact on shipping demand. We expect average distance to continue to grow in the next years. Talking about new buildings, we registered 22 new orders during the last quarter, taking the year-to-date total to 25. All these are linked to long-term contracts, and we should expect this to be the case with new orders in the near future. The order book stands at 124 LNG carriers, 16 remaining to be delivered this year, and almost 50 expected for 2021. This has become the main concern for market along with LNG demand growth. Asset values continue their descent in 2020. The new building price reference fell to $180 million. That is $1.5 million below previous quarter and almost $5 million lost since the start of this year. Second-hand values get even more downward pressure as more vessels become on sale in a very liquid market. Our steam and tri-fuel diesel electric references losing around $30 million so far this year. And that was our review for the last quarter. This and a lot more information is available in our quarterly report. Now, as I speak, the market is developing quite fast. The start of winter has caught the market with a lower level of LNG heading east, and Asian spot LNG price has recovered very fast. What is now becoming a common feature for this time of the year, prompt vessel availability is below 5 and charter rates are shooting up past the 6-figure mark. A cold winter could have important consequences for the market next year, something we plan to cover in our next LNG update. To wrap up, charter rates recovered in Q3 helped by gas prices. New building orders came back strongly, adding 22 vessels to a total of 25 this year. And with 50 new building deliveries next year, this is a concern given the general LNG market expectations. Asset values, both new building and second-hand vessels, showed more downward pressure. And finally, a sudden jump in Asian LNG price is calling for a strong export recovery towards winter. Charter rates are shooting up, which triggers the usual wait-and-see approach from potential sublets, reinforcing low prompt availability and stronger charter rates. Thanks for watching, and if you're interested in our scenarios for 2021, check out our soon-to-be-released video on this topic.